Yeah, everyone, or good afternoon from wherever you're joining us from. Welcome to our session today. I'm quite excited to be with you again this afternoon to go through the current market condition, to see where we started off the year, and most importantly, how the beginning of this month started. We all saw the I guess the news that happened in the global markets, and the reactions that we've seen directly impacting our portfolios. So I thought it was a very good idea, or very good timing, to have a session today to look at the current market trends, but also the impacts on our portfolios. I have here with us today Jorge, which most of you know from our previous webinars, that will take us through a short presentation. So we're hoping to have a presentation of around 20 minutes, and then we'll leave some time for some questions as well. If you have any questions as we go through the presentation, you can pop them through the chat, or you can send them to me after the session as well, or we can go through them at the end of the webinar. So without further ado, I'll hand it over to Jorge to take us through the presentation and let us know the latest updates on the AI portfolios, the performance, what we need to be looking out for, and how we have been managing the portfolio in the past month, given the current volatility that we've seen on global markets. Thank you, Jorge, for joining us. I hand it over to you. So welcome, and thanks again for your time this afternoon.
And good afternoon, and thank you for your time, and thank you for organizing this call. And I think, again, these calls are very important, especially when we have periods of volatility, periods of uncertainty. So this is a good time to have these calls on a quarterly basis. So good afternoon or good morning to everyone, and good morning from the East Coast of the United States. And today we're going to provide an overview on the markets, what's causing this volatility, but more importantly, providing some guidance in terms of what we see in the marketplace, what we see happening in terms of interest rate policy, everything that's coming out of Washington, D.C. with the Trump administration, and put something into perspective in terms of, where can we go from here, taking into account the volatility that we've had in the first quarter since the Trump administration took over in January, and how what we've seen in the most recent developments, as the situation has been very fluid and it changes almost on a weekly basis. What we have in Prospero with the ETF portfolios that are managed by the artificial intelligence solution, by AI, really it's designed for these market environments. It's designed when we have periods of heightened volatility or uncertainty. We have an investment solution that adjusts on a weekly basis, that has the mechanism to adjust to changing market conditions, with the objective of obviously preserving capital, which is the number one objective of any investor. And so with the AI portfolios, what I'll show you in a couple of minutes is how fluid, how dynamic it is in achieving that objective and preserving capital, and obviously optimizing returns. And then we have the benefit and hindsight that we've been running these portfolios since 2017. So we have 8 years of performance track record that we can see not only in the recent developments, but also going back to even I recall doing this call back in 2022 or early 2023 when we had that period of down markets as well, and how those markets recover so strongly in the following period. So always these periods of volatility, uncertainty sometimes provide opportunities. And so it's important to sort of try to see the big picture in everything that's going on. And then obviously, either if you're invested for the long term, stay the course, or just get some more information so we're all informed. So with that, I have some prepared information that I'd like to go over high level, and then we'll open it up for any questions if there are any questions, or we can conclude. All right. Sort of the meeting objectives for today is brief introduction into the AI portfolios that we managed that I just did. What I really want to do is my proposal is to really address the market concerns, reinforce, the long term how we invest, and what are the convictions behind that, and then I'll touch on the main topics of today, which is the U.S. economy, the world economy, inflation, how that impacts really what's dictating the central banks around the world, not only the US Federal Reserve, but also the European Central Bank, Bank of England, and so forth. Put into perspective what's causing this volatility, what we can expect from interest rates. Interest rates obviously drives the cost of money. And we'll talk in the equity markets, and we can talk about the most recent things on the Trump tariffs and so forth. So in terms of just the big picture, so the U.S. economy, while it has slowed from last year, it continues to grow, and it continues to grow. Approximately the consensus from Bloomberg, which takes all of the main investment banks around the world, the consensus is that the U.S. economy will grow at a 1.7% for 2025. While this is slower growth that we've had from the prior years, this is an important catalyst. Why? Because in 2022, in September of 2022, right after COVID, right after the pandemic, and we had all the central policy adjustments come on, aid, that created a lot of inflation, and then Federal Reserve and all the central banks moved very aggressively to increase interest rates to slow down inflation. And we're going to see in a couple of slides that it looks like inflation is coming down. And so it's important to note that the U.S. economy continues to grow, the world economies continue to grow at a slower pace, which helps inflation, helps reduce interest rates. So that's a positive catalyst. Growth remains positive. And then if we look at in terms of labor and unemployment in the United States, it continues to be very low. And so another positive catalyst. And then, the consumers, what drives the economy, and consumption continues to be at a very good pace. So all in all, the economy has slowed down, which is beneficial for inflation, is beneficial for interest rates, possibly where the Federal Reserve can continue to decrease lower rates, and how that translates into the overall economy. So if we look at the growth of the U.S. economy, and again, we focus on the U.S. economy. The U.S. economy leads all the global economy. So as what happens to the U.S., sort of the world follows. So if we look at the chart, and this is a quarterly chart looking at GDP growth, the economy. What's the growth of the economy over the last 2 years or so? And we can see that growth has slowed down from 2.3 that we were growing in the second quarter of 2023 to now 1.7. While the bottom of the chart, it's at 1.7. It's obviously we're above no growth, and so the question is, will the U.S. economy enter a recession? We don't see it, or consensus in the marketplace, they don't see it. They see it more as a soft landing. Again, behind the low unemployment numbers, the unemployment remains well below the historical average, so that's a very strong catalyst. And so we don't see a recession as a base case. We see sort of a slower growth, which again will spill to lower interest rates, and that could be very beneficial for the equity markets. And so I've mentioned inflation. So if we look at the headline inflation, it's still above the Federal Reserve target. Federal Reserve likes that, their target inflation is to have at 2%. We're currently running at 3%, which is much lower than we had about a year ago, which is a positive catalyst. So once you have inflation, it really takes 2, 3, 4 quarters, or it takes, a year or so for the inflationary pressures to come under control. And so what we're seeing is that inflation is coming down. And in terms of the the tariffs. I think one of the things that's really that caused all this volatility are the Trump administration's announcements of tariffs globally, and then a very strong stance with China. That happened about, it seems like a long time ago. It happened about 4 to 6 weeks ago. Most recent development just this week, it looks like the U.S. is de-escalating this economic threat of tariffs, and so they're scaling back the tariffs not only for China but for all of the global trading partners. And we've seen a positive reaction in the equity markets just in the last couple of days, just based on that news. So we're starting to see some more policy certainties. We're starting to get more clarity on policies, and again, this is common when a new administration comes into place. They adopt new policies. Obviously, looking at the Trump administration, they've been at the pace that they've been going with all these executive actions is caused these uncertainties. But when we look at inflation on the chart, so how to read that inflation? So inflation, there's three components of inflation: the price of goods, that's one part; the price of shelter, rent, that's another part; and the price of services. The price of goods have come down significantly, outlined by the blue line. The price of rent and services has come down slower, so that's stickier inflation. That inflation doesn't come down as fast. But what we can see is that, again, from the period of 2022, when we had this very high inflationary pressures, the Federal Reserve and all the central banks reacted to this. Inflation started coming down. The price of goods started coming down. So that's in line with expectations. And so what we're seeing is on the trend line is that rents and services are also trending lower, which is very positive for the market. And so we see that there's a high likelihood that the Federal Reserve will decrease rates. The European Central Bank is actually have been much more aggressive with this, and they've lowered their rates already this year. So that's very good, and we can see that in the equity market. So while this sticky inflation is starting, it's been around, it's starting to come down. So that's a positive sign for that. And so in terms of looking at these three components, if we put them all under one, and we can see where the headline inflation is running roughly at 3% currently, and what the Federal Reserve target is really that dotted line. They want to be at 2%. They want to be 2% in full employment. And so really one of the things that the market is trying to digest is, well, this impact on potential tariffs, whether that could be inflationary. And so what does the Federal Reserve do? And so in the last meeting, the Federal Reserve indicated that they were going to stand by and look at this for a couple of more months and see the impact. But again, it looks like the tariff threats are starting to de-escalate. And so I think we'll see some positive catalysts on that. So we do see interest rates coming down at some point this year, which will be, again, which would be a positive catalyst. So if we look at the charts, sort of a busy chart, but these are the short-term interest rates that we have in the marketplace. And so what we can see is that the positive is that on the right-hand side of the chart, we can see that, again, the red line is European Central Bank. They've decreased rates. The Federal Reserve, the Bank of England, and the Bank of Japan actually started increasing rates. They're looking at it from a complete different picture. But the big picture is that the rates are coming down. That's very good. That's very good for bond prices. That's very good for real estate prices. That's very good for a lot of things. The cost of money is decreasing. Also, the yield on U.S. Treasury bonds, which also has made some of the headlines, that spiked up about 2 or 3 weeks ago, again with the uncertainties of tariffs, but again with the developments as tariffs will de-escalate. Those Treasury yields have come down as well, and so another positive catalyst for the marketplace. And we've seen how the market has reacted to that, so that's very important. So really what's causing this, it's summarized sort of here. So what's this, market volatility and, the function of policy uncertainty. When the market has uncertainty in terms of what policy could be, the volatility index, or measured by the VIX, which is the green line, really the blue line is really spiked up. And so we can see, going back 25 years, when we have policy uncertainty coming out of Washington, D.C., that produces a lot of volatility, and volatility produces down markets. So that's how sort of we read that. So because we've had this uncertainty in what the direction and what the Trump administration wants to do, or what the impact could be, not so much on the short term, but medium to long term, that produces volatility, that produces, the up and down markets that we've seen in the last 6 weeks or so. But again, we're starting to get clarity on that. And so that is a positive catalyst. Not only do we have tariffs, but also we have the geopolitical risks or tensions that we have in the Middle East, and obviously the Russia-Ukraine conflict that they're trying to find a resolution, and trying to move forward with some sort of peace treaty. So that's constructive for the market. So we see that the markets are starting to get constructive. So again, what we see volatility, as I mentioned earlier, is sometimes this produces opportunities. When asset prices come down, and when I mean asset prices, the values of the largest companies in the world, when those values come down because of these short-term uncertainties, then we have an opportunity to buy things that become cheaper, right? And so that's that's one of the objectives of making good returns. So I'll go into how the AI ETF portfolios, how they manage this, and how they take advantage of that. But more importantly, we see that this is getting very constructive. The volatility, as well, as we've seen, it's interesting. It's being led really by what the market calls the Magnificent Seven. So it's sort of like an old Western, the Magnificent Seven. It's the seven largest companies that predominantly are in the technology field. So it's Apple, Microsoft, Google, Amazon, Facebook, Nvidia, Tesla. These stocks are the ones that have driven the market up high, in the last several years. And if we look at sort of the chart from earlier last year, from January 24 to now, these stocks have led. They've had over a 40%, 41% return, while the rest of the S&P has led us with a 16% return. So again, this volatility is being driven by profit taking by some of these positions, but overall we see the market being very constructive. But it's only interesting to point out these leading stocks. So while we have short-term volatility, I think it's always important to keep a medium to long-term view. So this chart is looking at the different indices around the world. So the Standard & Poor's 500, the S&P 500, which is the U.S. economy, the Russell 2000, and we see the MSCI World. So we see different markets: the U.S. market, the global markets, emerging markets, the Asian markets, and then we can also see some of the sectors. We can see energy, financials, healthcare, industrials, technology, and so forth. So we can get a big picture on what's happening in the last month, the last 3 months, year to date. But more importantly, what's the average annual return on a 3-year basis, on a 5-year basis, on a 10-year basis, right? And so if we look at 3-year basis for the S&P 500, it's a 9% average annual return over the last 3 years. If we look at the last 5 years, there's an 18% average annual return, or over the last 10 years is a 12% average annual return. So that's sort of to keep in perspective. And we do see periods of volatility. So last year we had very good markets. The S&P returned over 25%. That was preceded with a 26% in 2023. But then we see, as I mentioned earlier, the 2022 market where the S&P was down 18. So it's important to keep these to keep this into perspective. When we have these periods of volatility, the first reaction is maybe to unwind positions or to lead or to undo investments. And that leads to realizing loss. So if your investment horizon is medium to the long term, the markets over time, the markets always recover, right? And so we saw that from 2022 to 23, and then obviously 24. And so again, I think we'll get past these markets as we get more certainty behind the strength of not only the U.S. economy but the global economy. So a long-term view is important to keep in mind. This is sort of a periodic table of returns, and so when we look at different sectors, right? When we have different, diversification is key. So we have commodities, we have US stocks, emerging market stocks, European stocks, and so forth. We can see they all move in different directions at different times. So diversification is a key. Not one single market produces consistent top returns over a year. So this leads to the key of being diversified, but being nimble, having the ability to move in and out of markets. And so the Prospero AI ETF solution, the strategy, does that for us. And I'll go into how that's performed. So one of the main key takeaways is we don't see a recession. We see more of a soft landing. We see that inflation, while it might be sticky, it's manageable. So we do see that the Federal Reserve and the central banks continue to ease or lower rates. Volatility, again, is normal in transitionary periods. This has been, recently has been a heightened volatility, but again, what we've seen, in the most recent announcements is things are starting to abate. And again, the Prospero AI portfolios utilizing AI, it's a very tactical, dynamic solution that takes advantage of these periods. So with that, I'm going to go just a high summary, and probably what Ann discusses on a daily basis is we have four different, or really three different portfolios. We have the AI conservative, AI balance, AI growth, and the dynamic. But I'll focus on the first three. And the main thing on these portfolios is, again, they have the flexibility to move between bonds, cash, and equities and commodities. So while we want to produce the best type of return, the portfolios have enough flexibility to move into cash that I'll show you in a second, and optimize returns, but while maintaining volatility at the lowest possible measure. So these portfolios, they allocate, or they move on a weekly basis, which is very different from most investment strategies or investment solutions in the marketplace. So when we have a down market, like we've had a down market, these portfolios have the ability to move into cash, to move into bonds, to move into the safe assets. And when the markets recover, which is important, after a down market, the markets recover they recover very fast. Then they have the ability to move into equities, to move into commodities, move into these asset classes to capture the upside. So they have the ability to be defensive in a pullback, and then as the market starts to turn, they can allocate into it. So and they do this on a weekly basis. So when we look at all of the different investments in these portfolios to say, well, what can they invest in? They invest in the broadest indices or in the broadest market. So they provide a lot of diversification. They're not buying individual bonds or individual companies. They're buying indices. So it's the US market, the European market, the Asian market, the emerging markets measured by these indices. And then on the fixed income side is where the investments can be made in treasury short-term maturities, treasuries long-term maturities, corporate bonds, emerging market bonds. So really having a pretty big universe of investments to invest in. And what the AI solution is doing is identifying what is the best investment for that following week, right? It's looking only at 7-day segments. So it's taking into account a lot of market data and coming up with a forecast for the following 7 days. And based on that, it will select different investments. These investments are managed by the largest asset managers in the world, by Vanguard, by BlackRock. BlackRock manages over $8 trillion, so they're the largest asset manager. So we utilize their indices to invest and diversify. So that's a bit about that. I'll show on the screen. I'm showing the AI balance portfolio that many of Sandland Private Wealth Management investors have. And so we can see the performance on a 1-year basis, while it's lower than average, on a 3-year average annual return, 6%, on a 5-year average annual return, 5%, and since inception, since 2017, a little over 5%. This is the context of having low volatility. So when we look at standard deviation, which is a technical term for volatility, has a measure of 8. What does that mean? That means that if we compare it to the S&P 500, right, the S&P 500 has a volatility or standard deviation of 18. So this is less than half of the volatility. This is more similar to the volatility of the bond market or the U.S. aggregate bond index. So we maintain, again, the objective is to avoid downturn, to avoid volatility while maximizing returns. Then I'll show you in terms of how these portfolios are very tactical in nature. So when we look from 1 week to another, so if we're looking at the current week, the previous week, this was last week, and then looking at the current week, and we're looking at the different indices, and I'm going to explain all these numbers and all these charts. So what we're looking at is, how is this portfolio invested last week compared to this week? And what we can see is from last week to this week, last week, the portfolios were invested in 20-year treasuries, 16%. For this week, they went out of treasuries completely, right? Last week, they had nothing in gold. This week, they had 4.3. And again, this varies on a weekly basis. It had exposure to the Invesco QQQ Trust, which is NASDAQ, which tends to be more technology-based, tends to produce higher returns than the Standard & Poor's 500. And an important part is last week it had 34% in cash. This week it went into 55% in cash. So again, these are very tactical portfolios that when there's, again, volatility, it doesn't always get it right. When there's volatility, they have the ability to go into cash much, much more than the average investment manager investment portfolio. So these are the allocations. On the right hand of the screen, on the lower right hand of the screen, what we want to really focus is, well, what was the net equity exposure for those 2 weeks, which was at the lowest possible limit. That's the lowest possible boundary of 40%, exposures to gold, and a big exposure to cash, which again, cash is defensive, right? It's when you go to cash, then obviously you have volatility. Now markets, it does produce. Now, this process repeats every single week. So next Monday at 4 p.m. Eastern Standard Time, New York time, we'll get the new allocations. And so they will recalibrate, they will readjust. And so we'll see what the portfolios will do on this. And again, this is being used, these portfolios are being run by artificial intelligence, which means that it's basically doing a lot of math. It's doing a lot of computations, taking a lot of market data. And again, it's trying to come up with that 7-day forecast to optimize portfolios to get the best return for that given week, and it adjusts on that weekly basis. Moving on to the growth portfolio. The growth portfolio tends to have a higher percentage in equities. And so when we see the returns, this is through March, the portfolios were down, little over more than 1%, but on a 1-year basis, 6%, on a 3-year basis, average annual 10%. So 10% over the last 3 years, every single year. On a 5-year basis, very consistent at 10%. And since 2017, close to 10%. So it's been very consistent in, since inception, and maintaining, again, we're looking at volatility, maintaining that volatility measure low. So consistent returns. And again, very tactical in nature. So very similar to the previous portfolio that I just showed, the balanced portfolio. We can see that last week it had 25% in U.S. Treasuries. That went to zero this week, and then the other major move went from 14% in cash to 35% in cash. So again, it moved to a defensive position. So this is being done on a weekly basis, and we can see how the conclusion is, what we have periods of up markets, down markets, we see that the performance. I also like to highlight, just to conclude, 2022, this portfolio in particular was down 22%. Had you sold that portfolio or sold in that period, you would have missed, the investor would have missed the appreciation or the recovery in the following year. So while this was down 20%, the following year it produced a 42% return. So not only did it make up for the loss from the previous year, but it made additional return. So very, very important thing to maintain is when we have these periods of volatility, it really is opportunities to buy things that become more inexpensive. Or the best thing is to stay the course if your investment horizon is for the long term, for 3 to 5 years. So with that, what's the key to investment returns is staying invested through market cycles. Market timing, meaning, going into the market or trying to sell and trying to buy. You miss key days of recovery. The AI solution is doing that for us on a weekly basis. So it's really being very, very tactical. And the objective of the portfolios is to optimize the returns, taking into account risk. So maintain risk low and get the best possible return. So with that, and those are my prepared remarks. I don't know if you have any questions that you've received or anything that you want to address.
Thank you for that, Jorge. I think that was very, very good. I think short and focused. It's just some key takeaways that I got from the presentation. Perhaps if we can mention that again. But we've obviously seen and heard all the noise. There's a lot of noise at the moment that we've seen every day. It changes, and from where we started 6 weeks ago to now, the markets have gone very down, if I can say it like that, after the news of the tariffs, and there was a lot of volatility. It's still the case now, but the markets have still picked up after there was a few adjustments that Trump made, and then we saw the markets go up again, and then now, like you mentioned, a couple of days ago now with China, so we've seen a lot more perhaps confidence back with on the investor side. And what I'm also pleased to see is that tactical allocation that the fund has on a weekly basis. So at any given time, it can move a portion of the fund back to cash, because what we don't want during those times of volatility is to see our fund, our portfolios keep going down, and that's when we start to lose sleep over, and that's what we don't want to happen for our clients. So that ability to switch a portion to cash and then to reallocate the following week as we see the opportunities, this is exactly what we need in an actively managed portfolio. And this is the same message that I try to, I guess, reinforce when I have my meetings with clients, is that the AI portfolio takes advantage of that, of everything it looks at for that past week, moves it tactically to cash, and then reallocate to the market, in the following week. Having said that, the some questions as well that I've been getting from clients in the past few weeks is, and you touched on that as well, is the view on the US market, because at the moment the portfolio is more US centric, but there is that ability to look at other markets, so let it be European markets or emerging markets or Asian market, I guess does the model, I'm assuming, does take that into consideration when looking at reallocation.
Yeah, that's a good question, Anne. So I'll move here into in terms of the different indices, and I'll share on that. But before on that, so I think in terms of what we see from the Trump administration, and really, if you see his book that he wrote back in the late '80s, early '90s, The Art of the Deal, it's really a blueprint of what he's doing now. He is an aggressive negotiator, and he asks more than he gets, right? So he tends to overshoot, and so he's pretty much following, interesting enough, that playbook that he wrote so many years ago. So with the tariffs, he was very aggressive with the tariffs, and obviously he's moderated significantly with China. And again, this is being driven by market volatility. So he gets. So I think he got the administration got the point that they have to moderate, and we've seen that policy stance on that. So we see that constructive. But to your question, yes. So to your question is, the AI portfolios can invest specifically in the U.S. market, or in the if we look at the second instrument, the MSCI EFA, that's Europe, Asia, and Far East. So that's international stocks. So everything developed markets, non-US. It can go into emerging markets as well. It likes to go into the AI. Not it likes it. It selects the QQQ because that is the best over the medium to long term. That index produced the highest and best returns because it's and then that index has most of all it's influenced by a lot of the technology companies. The technology companies, that's what's been driving the market for the last 10 years. So it tends to select that because that's the best driver for returns, the best driver for performance. But it does have the ability to look at emerging markets, look at international markets. It also looks at, if we look at, where is it, the consumer staples select sector. So consumer staples is defensive companies, companies that, consumer staples are, all the McDonald's, right? There's companies that people consume on a daily basis, right? And so those companies tend to move more defensively. So it has in the past several weeks, it has chosen to go into consumer staples and go into defensive equity position, but it has the ability to do that, and obviously it can go into emerging markets. And on the fixed income side, it could also go into U.S. bonds, corporate, European bonds, emerging markets, international bonds. It has all the options. It also has the options to go into gold, and we've seen gold rally significantly in the past year. And so it has the ability to go into and capture that upside performance. Gold is a hedge, right? When there's periods of uncertainty, gold rises, and that's what we've seen, the rise in gold. And then the ability to use cash as an investment option. So most investment managers do not utilize cash. They tend to move in different assets. The AI solution is looking at cash as a position. So when there is, again, periods of heightened volatility, to reduce risk, goes into cash. And then again, it will look at it on a weekly basis to get back into the market. So the most important thing is, when you want to de-risk a portfolio, is not selling and going into the sidelines, but when do you get back in? Mm-hmm. And when you get back in is the most challenging aspect, even for professional investment managers, right? Because you want to get back in when the storm has abated, when you see, a better horizon. And when you see that, the market tends to recover very rapidly, very fast. And we've seen it in the last trading. We saw just last couple of days, the QQQ, the Nasdaq was up 3.5%, right? So if you miss those days, is critical. It's critical for performance. So so yeah, so to your question, it is US centric, but it's US centric because the Nasdaq, the QQQ index, tends to be the best performing index out of all the indices, right? So it's looking to optimize returns, and it's only looking, on a weekly basis.
Yeah, and to your point as well, that volatility that we see, it produces opportunity, and what we don't want to be doing now is to move on the sideline, because, like you said, by the time we realize the markets are up already, it will be already priced into the market, and by the time you get back in, it will already be too expensive to get back in. I think that's very important as well to note. I'm not sure if you have any further questions, but please, if on your side, on the attendee side, if you have any other questions, I'm here. So don't hesitate to contact me, and you all have my details. I'm happy to share any questions as well with Jorge, and attend to any queries that you have. It is uncertain time at the moment, what we're living now, but it's also the time to stay within that investment strategy that we set up. We are long-term investors. We're not here to trade in and out of markets, but we want to make sure that on the long term we see that line going up when we look at the performance of our portfolios, and that's why it's crucial to stay informed of what's happening, but also make sure that the portfolio is performing how we want it to perform. So on that note, Jorge, thank you so much for your time. Thanks for the presentation. And like I said, let's keep in touch and organize perhaps the next webinar in the next 3 months or sooner if there are any changes.
Perfect. Yeah, no, thank you. Thank you for all your support. Thank you for Sandland Private Wealth. The job that you guys are doing is fantastic. And then again, if you have any questions with any investors, we'll happy to have another call and address any concerns. But again, thank you. I wish everyone a great day, and we look forward to the next call.
Thank you, everyone. Thanks for joining, and we'll keep in touch. Bye. Thank you, Jorge.
Thank you. Bye-bye.